Welcome back. We finished question number 3A in the previous video. Now it is question number 3B. What is the examiner asked you in question number 3B? This is all about computation of cash flow from operating activities using which method? Method is silent, but here the method shall be indirect method. Why? Why? Because we are given net profit before tax and items which are debited or credited to P&L, and also given the current assets and liabilities which actually represents the working capital. So based on this information available in the question, what we can clearly understand that this is not a direct method, because direct method is based on receipts and payments, whereas indirect method is based on calculating backwards from net profit so that you can arrive cash from operating activities. Now let us read the question. The question here is net profit before tax is given, depreciation which is a non-cash expenditure, interest on long-term borrowings which is non-operating expenditure, amortization again a non-cash expenditure, gain on sale of machinery a non-operating income. So these are actually not a part of operating cash flows. This is non-operating. We can say interest on long-term borrowing. When we borrow, it is a financial activity, and depreciation non-cash, amortization non-cash, gain on sale of machinery is investment activity. So basically here we are computing only operating activity cash flow. Hence these items should be adjusted, because your net profit is arrived after debiting or crediting these items, and then we should go to working capital plus or minus. We'll explain when we do that. So now let us go back to the solution where we should start the presentation. The heading shall be cash flow from operating activities, and I'm calling it as indirect method. My starting point should always be net profit from P&L before tax, which is given 3,40,000. Now I should add back non-cash expenditure debited to P&L. It is given, right? What is non-cash? Number one, depreciation, and number two, amortization. This is for tangible assets. This is for intangible assets. The depreciation is 85,000 because it is a non-cash expenditure. There is no cash outflow in real terms. Though it is an accounting expenditure, it is not a real cash expenditure. Similarly, amortization, which is not a real cash expenditure, because we debited these two, your profit is reduced. Now we are adding it back to see what is my cash profit from operation, cash inflow from operation. Then I also need to add back non-operating expenses debited to P&L. What is my non-operating expense? Here is interest on long-term borrowings. Interest on long-term borrowing, that is 40,000. So I added back non-cash expenditure debited, non-operating expenditure debited, and one more, gain on sale of machinery, which is a non-operating income. I should deduct non-operating income credited to P&L, which is my gain on sale of machinery. Because P&L account don't differentiate between operating, non-operating. It debit all expenditure, credit all incomes, but when it comes to cash flow, we should always compute what is the cash flow from operations, from finance, and from investing. So gain on sale of machinery here is 30,000, which I am deducting. So I got my operating profit 3,40,000 plus 85,000 plus 50,000 plus 40,000 minus 30,000. My operating profit is 4,85,000. This is my operating profit before working capital changes. Your working capital also affects your operating cash flow. So there is no tax given, so I cannot compute operating inflows after tax, but I can compute operating cash inflows before tax from the information. Now I should see adjustment for changes in working capital. I should do my adjustment for changes in working capital. Here we should understand why I should do this. When I purchase inventory, there is a cash outflow, that is operating. And when I make a debit sale, credit sale, I can say, when I can make a credit sale debtor and my sale is made, income recognized in the P&L, but the amount is not collected. Similarly, when I purchase some inventory and didn't make the payment, I didn't make the payment to the creditor. So I need to see what are the changes in my current assets and liabilities affecting my cash flow. The number one in this question is trade receivables decreased. When it is decreased in trade receivables means increase in cash flow. So what I'll do here is add decrease in trade receivables. It shows cash inflow because receivables decrease means cash collected. How much cash collected here? 35,000. Similarly, increase in payables. Increase in payables in the sense I purchased my stock but I didn't pay. So increase in payables is also my cash inflow because I saved the cash, I didn't pay in this particular period. So increase in trade payable is 10,000. And inventories increase. Increase in inventory means I purchased, my assets were increased without sale. So my working capital blocked, my cash is blocked because I purchased the inventory and it is more, which is deduct 20,000. And increase in prepaid expense. When I make expense prepaid, it means my cash outflow is more by 5,000 here because I paid more cash towards expenses which is not required to be paid, but I paid. So my cash is outflown. So my cash gone out. And then income received in advance, you receive the cash. So increase in advance receipt of income, which is 10,000 I should add. So my profit before working capital changes, operating profit is 4,85,000. I am adding 35,000 which is decrease in receivables, 10,000 which is increase in payables, and I'm deducting 20,000 towards increase in inventory, working capital block, cash flow, and increase in prepaid expenses and increase in advance income which is more received. So my overall operating profit before tax, operating cash flow before tax is 5,15,000, which is what they asked. In this question, tax is not given. If tax is given, we should deduct the tax from this to see what is net cash generated or utilized from operating activities. So the answer can be done in very quick pace to score 7 marks for this question, and this can be done exactly in say 8 to 10 minutes, but you can get full marks. And do it in a format. You have particulars and then you should have amount column so that it looks more appropriate presentation in the examination. So 5,15,000. How we identified it is indirect method because there is no data about collection and payment from debtors or creditors to creditors. No information on payment of salaries, but there is information on net profit from P&L. So we should compute backwards by what? Adding non-cash expense and adding non-operating expense, deducting non-operating incomes, and adjusting for working capital changes. The thumb rule in working capital changes is increase in current assets is outflow, decrease in current assets is inflow, increase in current liabilities is inflow, and decrease in current liabilities is outflow. While talking about current assets and current liabilities, I ignore cash and cash equivalents because I am preparing cash flow, which should be the reconciliation between opening and closing cash balances. With this, the solution is completed. Thank you. We'll meet again with another sum and another solution.